Okay, great. So everybody, welcome to the webinar. My name is Cornell. Thanks for your patience as we got everything up and running. I'll be the moderator today. Congratulations on getting a spot. The webinar is fully booked. So I'm glad you were able to make it and that you got a hold of a spot. Okay, so I'd like to start off with introducing Peter. Peter Hodson has been known as one of the Warren Buffetts of Canada and is the founder of 5i Research, a truly conflict-free Canadian investment research service. So they don't trade in Canadian markets, no one pays them commissions, and they don't have to worry about offending companies. Now, before starting 5i, Peter was the chairman of Sprott Asset Management LP, one of Canada's largest and most successful hedge funds. He has managed over 1.1 billion in assets and has become one of Canada's most respected stock investors over his career of 30 plus years of professional investing. Now, as the head of research at 5i Research, Peter and his team produce easy to understand reports on Canada's top companies to invest in. They have 3 model portfolios for different types of investors. Their balanced portfolio has returned over 168% since inception, which is over 20% per year annualized over the last 5 years. And they have answered over 75,000 member questions. All right, now before Peter takes over, we wanted to thank Financial Post for co-running this event with us. Peter has been writing for the Financial Post for at least 12 years now. We're big fans of the newspaper, and if you're not a currently subscriber, you can get access to the digital version of the entire National Post, which includes Financial Post, and you can get that all on your tablet, your phone, and computer for free for 2 weeks by going to the special link that they have provided right here. All right, so that's epaper.nationalpost.com. So right now, feel free to type that link in your browser so that you can take advantage of that. And I'll leave that link in the top right of the slides too for the next few slides, just so you have time to check it out. All right. Sorry, I'm rushing a bit here, but I know we're running a bit late with that technical hiccup. So I hope you're interested. And without further ado, here is Peter.
Thanks, Cornell. Okay, let's get right into it. I also would like to thank the Post. They've been very good to 5i and also to myself. And there's nothing that will ever compare to being able to select a stock at $5 or $6 and having it go to $200 over a couple of years or 10 years. But I must admit, having my first column published in the Post 12 or 13 years ago was a pretty fun event as well. Not quite as good as the stock picking when it works well, though. So I'm going to turn some bad news of our 6-minute delay into some good news. We've never had to use 2 webinar providers before. And so we kind of have sold out demand for this webinar. And what that tells me is that people are quite concerned about what's happening in the market. Investors are scared, investors are nervous, and they're wondering what's going on. And the good news out of that is the more people that are worried, of course, the more likely we are to be coming to an end of this correction or whatever you want to call it. So we'll just get past the legal. We're not registered investment advisors, so this is just our opinions. All right, we'll skip another commercial there. We'll get you more on 5i later. So looking at the market, we've had a very serious correction in a very, very short period of time. A little bit different than in February, where it was kind of over in a week. We've now basically started October with the worst month since 2011. NASDAQ, I think, is down almost 700 or 800 points as we speak. It's kind of dropping as we speak right now, unfortunately. The industrial average, the Dow Jones, is down about 1,500 points, and of course the TSX hasn't really done anything all year. The TSX now is down more than 7% on the year, but if you put it in US dollar terms, it's down more than 10% in US dollars because of the Canadian dollar weakness. So what's going on? A lot of people are blaming the Fed. Basically, the Fed is appearing to be too hawkish. They've raised interest rates 3 times already this year, with more on the way. And a lot of people are very, very concerned that the Fed's going to keep raising while wages are going up. There's lots of jobs available. And while you kind of go through the economic cycle where demand increases, productivity decreases, wages go up, prices go up, costs go up, and profits fall. So that is actually a very, very typical scenario for a normal economy. And a lot of people are just a little confused because we've had it so good for so long. What happens in a good economy is interest rates go up. There is pressure in the system, and the Fed tries to slow down that pressure in the system by raising rates. So a couple of points on that. First off, there is a lag impact on any interest rate increase. They do take a while to hit the economy. They may be hitting the economy right now, and the Fed is not stupid. I think they have 197 PhDs working for them, and this is just an economics 101 lesson. It does take a while for interest rates to hit the economy. So what that means is the Fed is probably not going to be as hawkish as people think. They're probably not going to raise rates as fast as people think because they have to give those prior rates time to digest into the economy. The stock market correction in and of itself is kind of like tightening at the Fed as well. You've got a confidence scenario, and of course, when confidence is weaker than it was, it's almost as if the Fed has been tightening as well. So the Fed's got a bit of a cushion. They can give themselves a bit of a time. I don't want to call the next rate hike. That looks fairly assured, but I think after that, then the Fed's going to sort of take it easy and let their work catch up to them. So what's happening in the markets? Corporate earnings are okay. They're not great. We're getting mixed results for the third quarter. And a lot of companies are blaming the trade war with China and input costs that are rising. Again, other than the trade war with China, none of that is unusual for a regular economic scenario, a normal cycle. So we've got some companies reporting good earnings, some companies reporting bad earnings. But with the correction, we've got valuations that have got back into relatively decent historical valuations compared to prior cycles. So unless you get a complete reversal of earnings, i.e. every company starts disappointing and guiding lower, then the valuations are okay, and you can probably work your way back up over the next 6 to 7 months, and even perhaps by the end of the year, depending on how deep this little correction goes. So you've got a scenario where investors, i.e. not traders, can probably start stepping into the market. Traders may want to wait for another 3 or 4% type of decline. We haven't seen the panic in the VIX index yet. We haven't seen the giant spike above 30 or 40 where everybody worries and everybody wants out at the same time. We haven't seen that yet. I don't know if we will. It looks to me like a regular type of scenario with a correction. So what do? Well, the best lesson is from history, and you take a look at all the other corrections. And most recessions are very, very short. They last 9 months, 10 months tops. And the market, of course, leads into a recession. So whether we're in a recession or not, as an investor, if you're got more than a 4 or 5 year time frame, you really shouldn't have to worry too much. And the best defense is to do nothing. There's all sorts of advisors who will take your money and provide advice and say, you know, go to cash or do this and do that and the other thing. And of course, as the market goes down, the doomsayers get more credibility, and they become more powerful in their doomsday sayings, and people get worried and they tend to do the wrong things at the wrong time. So there's nothing in this market that really looks different over what I've seen over the past 30 or 40 years. It may be short, it may be sort of a drag-on type of scenario if we get into some tax loss selling over the year end, especially in Canada, with very few stocks up on the year for Canada. But valuation's okay, corporate balance sheet's okay, profit growth okay, everyone who wants a job can get a job, that's pretty good. Housing market may be impacted by interest rates, but they're probably not rising much longer. And so you set up a scenario where you can actually recover from this over time. So if you've got a 1 month scenario, I would probably just sit things out. If you've got a 6 month scenario, you're probably okay. And as usual, as forever, if you've got a 10-year time frame, you're probably going to be just fine. Thank you very much, as long as your portfolio is well diversified. So skipping along, marijuana stocks, what can we say? We really didn't think they were going to go up so much. And now we've got a scenario where mutual fund managers are buying them to match an index. If you're in a competitive situation with another fund and the other fund owns 4% in a marijuana company and you don't, you're probably going to have to buy some to maintain your position on a relative basis as a fund manager. As a fund manager previously, that's what you have to do. If your bonus is tied to performance against a peer group and your peer group owns something, guess what? You probably have to own that whatever it is that's moving just to stay in line and get your bonus. So now you've got a situation where we're legal and investors are waiting for what's going to happen, and will financial results as they're reported quarter after quarter be anywhere close to expectations. So there's a couple of things going on. One, I think, of course, the first quarter might be interesting as you kind of get the novelty effect and consumers sort of go legal for the first time. So after that, though, it gets much more interesting. You've got a competitive situation. You've got shortages, perhaps. You don't have as many stores as people thought. But really, the valuations on the Canadian names are implying that the Canadian companies are going to take over the world when the rest of the world goes legal. And that may or may not happen. Certainly, the larger companies are in good position to be in that state to go in and take over the rest of the world as other countries legalize. But then I have to give you a bit of a reality check. From Trudeau's promise to legalization was 3 years. And now we've got 2 countries that are legal, and you've got a scenario where if the valuations are to be justified, you have to get a lot more countries going legal very, very fast. And I think investors are forgetting about the time frame. It's not an overnight scenario. It may be a 3, 4, 5 year scenario. And I think there's just a bit of a reality gut check going on right now in the sector as it kind of melts. The sector would worry me much more if the market really did break down for a period of time. You've got a situation where companies such as Canopy are up still 300% in a year. And if the market starts to crack a little bit and goes down 1% a day or 2% a week or even more, investors may be looking at those giant embedded gains. There may be some margin calls elsewhere, and it's pretty easy to sell something that's up 300% to solve your short-term problem. So we would remain cautious. We would rather miss a party than be there for the hangover. And we've seen lots of bubbles before, and there's going to be some very big companies that end up at the end of the game here with marijuana, but there's too many companies around with too much money, too much capacity, and not enough experience. And I think you have to be very, very selective in what you're doing for the sector. Skipping to tech, we were talking about this this morning. We're really not sure why people would be not wanting to own tech right now. As a sector, tech has the best balance sheets of all the sectors. From a growth perspective, it has the best growth rates of almost any sector. From a sort of innovation and new development, if you look at all the drivers of tech, AI, autonomous driving, you name it, there's basically a reason to be there. And now you've got this giant sort of rotation that's sort of occurring out of tech. But at the end of the day, that's where the balance sheets are. That's where the growth rate is. And I think over the next 5 years, that's probably going to be a pretty decent sector overall. Certainly, there's some valuations. We could talk about blockchain, or we could talk about some of the unicorns out there. There's certainly things that are overvalued, but you've got general tech names that are very, very cheap, that continue to grow, that have literally hundreds of billions of dollars on their balance sheet. Other than the sort of the short-term gyrations that go around quarterly earnings, it's not really a sector that would cause us a lot of concern. In the U.S., very different than Canada, the U.S. tech sector is 25 or 26% of the market, where in Canada it's 3 or 4 barely. So if investors are worried about the market, then tech as a large sector tends to get hit. But again, it's a short-term phenomenon, not a kind of a chronic scenario. We're seeing companies that are growing 40, 50, 60% with extremely high margins. And if you didn't know it was a tech company, you would be wondering, wow, that's the greatest stock I've ever seen in terms of margins, balance sheets, growth, and valuations. So we wouldn't be too concerned there, again, notwithstanding the volatility that we're having currently. Interest rates, we've touched on that. We're a little bit surprised that the Bank of Canada has been so aggressive. The Canadian economy is not doing as well as the U.S., and I think maybe Canada perhaps should have gone a little dovish in its most recent commentary and perhaps slowed things down a little bit. But it remains to be seen. But if I were to bet on one market versus the other, I would still bet on the U.S. market versus the Canadian market. And a lot of that is really by the way the Canadian market is set up, with resources, financials, energy kind of dominating the entire market. And unless those do something, you're really not going to get a whole lot of action going on in the Canadian market. Okay, let's skip the market and the economy, and let's go right into stocks, because it's always tricky to predict an economy, or very, very hard to predict a market, but it's a little bit easier to try and find a good company. Certainly, you can find a good company versus a bad company. The relative comparison is a little bit easier, certainly trying to find a good one versus a bad one. So what you want to do first, though, is avoid all the mistakes you've always made in the past, or one makes in the past, and everyone makes mistakes, and as long as you learn from them, then it's okay. So one of our big bugaboos is saying a company is too expensive. You get a company that is doing very well, investors like it, it's growing fast, it's got great management. Sure, it's going to double, it's going to triple, it's going to quadruple. And you should not discount it just because of that. You need to find out what's going on with that company and perhaps investigate it further. Gambling, everyone's gambled and lost, so I don't need to go into that. Selling too early is a little bit related to the first one. You will never get a 10-bagger. You'll never get an Apple or a Google or an Amazon if you sell after the first double or triple. You don't want to be crazy. You want to understand why something's doubling, but certainly don't sell it just because it's up. I think that's one of the worst things you can do. Waiting for a pullback, for those that are sitting on cash, maybe this is your pullback right now, but if you've got a great company, you very rarely will get a significant pullback in a great company, and you don't want to nickel and dime your way out of a fortune by waiting for a 50-cent cheaper stock that's on a way to, from $10 to $1,000. If you're trying to save 50 cents, it's going to cost you a lot of money if you don't own that stock in the long run. Keeping losers too long, everyone's done that, so we'll skip that, but it's very, very common. No one wants to admit a mistake, but certainly if no one else likes your stock, it's going to continue to go down, and just because a stock is cheaper does not make it better. And so we're very against averaging down. Just because you were wrong at $20 does not mean you're more right at $10. And you should be very careful about doubling up and tripling up into a loser. And then finally, looking where a stock has been. It's completely irrelevant. Stocks change all the time. There's always news, there's always events, there's always things in the world. The stock does not know where it's been. It doesn't care what you paid for it. It doesn't care if it's doubled. Look at where it's going and look at the future and future opportunities. So here's a chart on Diedrich's Coffee. This is a real-life example of a company at Sprott that we found after it had doubled. It went from about $1 to $2, and we found this company that we thought was quite interesting. Then we started buying. We drove it up to about $8 on our buying alone because we had $10 billion in assets that we had to deploy. And this was a company that was making the K-Cups for Keurig coffee makers. Business was good. Green Mountain Coffee needed more and more production. The stock went crazy. And we had an initial position that I think quadrupled before the company was taken over. And I only put that chart in because we had never even heard of this company until it had already doubled. And so if we had said, oh, that stock's doubled, we're not interested in anymore, we would have missed a ride from $3 or $4 to, I think the ultimate takeout price was in the $33, $34 range. So a more recent one, there's a company called Amarin in the States. They just came out with a very, very significant drug trial. The stock has more than quadrupled in the past 2 months, $6 billion market cap right now. But again, here's a company I'm far more interested in now at, I think, $21 than I would have been in at $5 a couple of months ago, because that drug study is perhaps better than anything we've seen going forward in the heart disease world. And it was 25% effective with no side effects and very, very cheap. So it's one of those scenarios where most drugs are very expensive. It's a small population, and they're not that effective. And Amarin's kind of hit the opposite of all three of those negatives to a new drug. But again, you have to be willing to buy something that's already gone up. Sources of ideas, there's so many. We like to look at new highs. We like to look at new highs with volume. What that tells you is that other investors like your company. And as I mentioned earlier, you need friends to buy your stock, or you're never gonna make any money. It does take other investors to push up your prices for you to make any profits. New dividends are important signals. There's a couple of new dividends that I'll just leave there for you right now. And we'll talk about that. And we have a little bit of a dividend section later, which we'll talk on as well. But certainly you can take note of what's happening in the market to get good ideas. And don't be afraid to investigate a new company that you've never heard of. If it's doing well, then certainly other people have heard of it and it's doing well, and perhaps you should find out why they like it as well. Financial media, there's all sorts of common sense things you can use. I remember 2008 standing in line at Starbucks about to pay $5 for a coffee while the world was ending and the financial system was completely collapsing. And I thought, well, I should probably buy some Starbucks here as I'm standing in line paying them money while the rest of the world is going to hell. And Starbucks, I think, was $7 at the time, and I went to 70. I think it's now in the 50s. But Google, of course, every time you entered a Google search 10 or 12 or 15 years ago was a good sign that perhaps maybe that company is doing something a little bit better. CDAR.com is the public marketplace for all public information. Seeking Alpha has got some good reports as well. I like Seeking Alpha to go into the negative side of a company. If you really, really like a company, pull up its report on Seeking Alpha. You'll probably get some short sellers commenting about how lousy this company is. You'll get some negative views, and it's always a good gut check to see if you're looking at the company through rose-colored glasses. And looking at charts is also important. We would avoid stock forums. CNBC is a media. It's an entertainment channel. Jim Cramer, he's pretty smart, but I wouldn't take any advice from him on the short term without doing homework. And of course, don't take a tip from your dentist. Dentists are one of the world's worst sectors or worst professional groups to invest. They're just horrible, horrible. So be careful about tips at the party, and don't be a follower. Don't have the I wish I had a weed stock because my friend has a weed stock. I mean, make sure you know what you're doing. And then finally, we have some free resources at 5i Research, which we're going to open up for you right now and show you how they work. And again, these are all free. You don't have to be a member.
Okay, so you just go to 5iresearch.ca.
Okay, bear with me for a second. So what we've done is we've hooked up with a data provider that will provide company information on almost any North American company. I can't tell you it's every North American company because I haven't punched in all the symbols. But for example, let's just type in Constellation Software, and then we'll click it down here, and we'll walk you through what we can provide here on. You got to put in the whole ones.
I think it's just lagging because we're running all these different things in the background. Okay, there we go.
Okay, so Constellation Software, we pull this up. It'll give you the current price. It'll give you the description of the company. It'll give you volume, closing, asks, weighted average, the high, low for the year, dividend dates, dividend payment dates, number of employees, et cetera, et cetera, et cetera. Now we do cover Constellation Software at 5i, and you can, if you're a member, you can click on that link and get a report. But if you're doing it for free, you won't. But there's an interactive chart. You can use that for 20 years to 1 day. I won't do that right now just to save time, but it's interactive price volume, and you can list events at what's happened at the company as well. So if a company is spiked up, you can click on a date and see when it spiked up and try and find out what happened. Revenue growth, liquidity ratio, management effectives, all these information in a nice, easy to look at format. Then we get in more interesting, sort of the more short-term stuff. You've got earnings, target price history, analyst estimates, which are pretty hard to find sometimes in an easy format. So we like what we've done here on this setup. Target prices, institutional holdings. It's just a whack of information that you can get here, share information. And then we have a question and answer service at 5i, and you can also click on those questions again if you're a member. There's also insider trading, which is also a little bit trickier to get sometimes, and recent news events. So basically, you can find out almost anything you want on this company, and that's all for free. So it's a pretty good source of information. Again, once you've got an idea, you do need to do some homework if you're a do-it-yourself investor, and this will certainly help you at least get down to the basics, and then you can go from there. Okay, so let's get back onto our format. Everything looks good here. So looking for, say you've got an idea. Now you want to know if it's a good company or a bad company. So let's look at what are the signs of a good company. First off, management is key. Everybody says that, and we just really can't emphasize it enough. The company that is the people that are running your company need to have the experience. They need to preferably have done it all before. They need to be motivated. They need to have the ability to solve problems, and then you have to be able to trust them. So one of the things I like to look at is how many shares do they own. It's very, very simple. It's available publicly. We want the company to be committed, the management to be committed, and not options. We don't want them to be rich if things work out. We want them to be poor if things do not work out. So Very, very key point as far as we're concerned at 5i. Increasing dividends, rising revenues, and we really like companies that are doing better. Nice little example from Canada would be Magna. For years and years and years, Magna was a company that was growing their revenue at 5 or 6%, while the rest of the industry was growing 1 or 2%. A very, very recent example would be A&W. A&W came out with a quarter last week with 13% same-store growth. In the restaurant business, that is just knocking it out of the park. If you're in baseball terminology, it's knocked out of the park, it lands on a subway, and the subway goes to another city. It was just an unbelievable quarter. You've got companies like Boston Pizza reporting negative 1%, and some of the other companies perhaps reporting 0.5% or 1%, and A&W comes in and reports a 13% quarter. They've got a new product, they've got a meatless burger, and everybody loves it, but something's going on there, and that's sort of a situation where a company's doing better. You got to find out whether that's sustainable or not. Constellation Software, that's the one we pulled up in our example there on the company information. Just a couple of points here. Primarily, the founder, still there, still running the company, owns $400 million worth of stock, so he is fairly motivated there. But more importantly for us really is the share count. I cannot tell you when this company has ever issued shares other than their public offering. It might have been 20 years ago, 25 years ago. It certainly doesn't go into our database. So they've grown into a $12 or $15 billion company with absolutely no share dilution, which we think is spectacular. And the share price has gone from $19 to, I guess it's down a bit today. It's probably 800 and something today in 12 years, but certainly good performance. But I think the key there is the share count growth. And that's, again, you can get this information and see how a company has diluted their shares. And this is if you own a company and a company issues shares, you now have to share those profits with someone else, and you really don't want to do that. More signs. Talked about industry company versus company growth. The Magna example will suffice for that. Barriers to entry. Obviously, a drug company like Amarin would have an advantage if they actually can patent their drug, or if you have a barrier entry such as Google, which has had a technology edge on search engines, on their algorithm. Market size. If you're a company that's growing into a very, very big market, then you've got a better chance. If the entire market is growing, then there's lots of money to be shared by different companies that are going into an industry or developing an industry, so that's one thing to watch out for. And then you have to watch out for companies that are cyclical or seasonal. They should have lower valuations, but a company that can consistently grow is better than a company that can only grow when the economy's good, like a steel company or other companies that perhaps have seasonality, like in the Christmas selling season. Some of the retailers, of course, they make all their profits in one quarter and they lose money the rest of the 3 quarters of the year. But we would rather have a company like Intuitive Surgical, which has got a robotic surgery solution that was $2 in 2001 and is now $505. Obviously, to do a robotic surgery arm is a little bit harder for an average person to do, and that's their competitive advantage. It's almost a monopoly in that business. More signs of a good company, a technology edge. We talked about Intuitive. There's lots of ways you can just do something better. Apple, interestingly, didn't really have that much of a technology edge. They just basically turned MP3 players into iPods, but they had a marketing edge, which was second to none, and that's how Apple's done so well. Patent, of course, is a good protector for a business. If you can drive costs lower, that helps you stay in business and shuts out competition. You can go into a new market. Plenty of Canadian companies have done this by going into difficult geological areas or politically sensitive areas where they go into somewhere where no one else wanted to go. In my fund career, I made a bucket of money on a company called Petro-Kazakhstan. It was a Canadian company that went in to develop oil fields in Kazakhstan. Started off at about 10 million market cap and was sold for, I think, 4 billion 12 or 13 years later, and nobody really wanted to go into that country, and they went in, took a risk, and did it very well. New service, new offering. Maybe I could use the example of Tesla there, where they came out with a sort of a better solution. A big brother relationship. I'll go back to the cannabis industry. Certainly the Constellation Brands' investment in Canopy is huge for that company. Just a massive amount of money and a massive amount of branding leadership worldwide. So if marijuana does become worldwide, then certainly that relationship with Constellation Brands for Canopy is going to be very, very important to the company. Market share, this is not the best example because the company hasn't done that well recently from a share price point of view over the past couple of years, but Cineplex has a 78% market share in Canada. They're not really worried about competitive theater operators. Certainly Netflix and streaming is more of a concern than another theater company coming up to Canada and try and get them out of their 78% market share. Looking at more things for a company, you want to make sure a company, if they have something special, they have a leadership, they keep it. You want to keep a very close eye on research and development expenses. Companies really can screw this up. They get complacent, they don't develop new products, and other companies come in and take over their business and drive their margins lower. So that's very important. But it can be a bit of a tricky indicator, because if you're spending a lot of money on R&D, your earnings are going to go down, or your earnings will be less than they were if you weren't spending on R&D. So go to the income statements and see exactly what's happening. And if a company has reported weaker than expected earnings, but R&D expenses went way up, perhaps they have a new product, a new service, a new something that's going to serve them well over the next couple of years, and you might be able to get a very cheap stock with huge upside potential from their research department down the road. It's not quite that easy, but research and development expenses are very, very important to look at. Companies need to keep moving. Andy Grove at Intel basically said only the paranoid survive. Basically, if you're a company that's someone else is getting in your way, you need to take them over or do something to compete, or just perhaps acquire them to get rid of them. And so we'll move to the example of Alphabet. I'll always call it Google, of course, being older. But Google had a competitor by the name of YouTube not that long ago. I can't remember the exact year, but YouTube was driving eyeballs away from Google, and one of the solutions for Google was just to buy YouTube, and now it's a giant cash flow machine for the company. So that's just a great acquisition, and you can see this happening in industrial land, in tech land. Basically anybody who gets in the way, the companies that have the financial fortitude to buy out their competitors tend to do much, much better. They grow faster, at the same time eliminating a problem. More signs of a good company, access to capital. We really like at 5i companies that have no debt. Debt is not so bad if it's manageable, but we've seen a lot of companies blow up because they have too much debt, and business turns down, whether it's their fault or the economy's fault. Debt will kill you in a bad market or when things go wrong. So we don't really go into the microcaps, the tiny companies. We'd rather have a company that's cash flow positive, that's been through an investment cycle, been through a recession, and still making money. We talked about partnerships. Obviously, if you've got a big brother and you've got a company that owns 50% of your stock, then you can access capital without going to the market if need be, if your partner is sizable enough and can provide you with some money. And working capital needs. A growing company, this is very important for a growing company. Growing companies basically burn through so much cash, and you have to make sure that you can do that, and while still meeting your company objectives. I've seen a lot of companies go out of business. They might have had the greatest idea in the world, but if they can't meet their payroll, it's not going to be a good idea, because the company's not going to be around. More signs. Auditors are important. Obviously, the size and scope of the auditor has to match the company size and scope. And so if you remember the fraud of Sino-Forest of many years ago, we had a $5 billion company that was being audited by, I think it was a 2-person auditing accounting team. So it's easy to say in hindsight that was ridiculous, but it was also there before the company blew up. And so take a look at who your accountants are, who's doing the auditing. We had a company that we looked at 5i. We didn't follow it formally, called Relic, and just last week they announced that some of their revenues were not going to be recognized. So this was a problem for us, and we kind of dropped the company like a hot potato. We don't want to deal with a situation where we can't rely on the financial numbers, because other than management, which is often giving you a sales pitch, it's the numbers that really do all the talking. Companies tend to promise a lot. We prefer companies that don't promise a lot. We tend to prefer companies that don't issue a press release every day. And just let the numbers do the talking, and over time your stock will do really well if you're a good company. Companies need to meet expectations. There's about 9,000 or 10,000 public companies we could follow in North America, and if you cannot meet your expectations, then your valuation is not going to be increasing, and other investors are not going to be happy with you, and your stock is not likely to really do a whole lot. So we'll just move on to one of those other 10,000 companies that we can look at. Dealing with problems, it's a little bit tricky without specific examples, but I like to sum it up with the weather. If I had $10 for every company that blamed the weather for a bad quarter, I'd have a lot of money. I mean, basically, if you're a retailer or if you're a manufacturer and you're blaming the weather, and it's just a cop-out. It's just an excuse. All your competitors had the same weather, and perhaps you just had a bad quarter, or something happened, or you missed a shipment, or a company canceled a contract. Just deal with it. Don't try and make excuses. And then communications to the street's important. Again, we don't need a company to spend a lot of money on investor relations. We don't need giant conferences. We don't need glossy reports. We would far rather have a company just deliver the goods, give us good performance numbers, and not promise too much, and whatever they promise, make sure they actually meet. So when you go down to the financial data, there's all sorts of ratios you can look at. We like to look at return on equity as kind of a single ratio to look at how much money are you making against how much money the owners have actually put into the company and shareholders. We talked about research expenses. You can use that in a ratio. Price to earnings, price to book, all that stuff is generally available pretty easily. But we like to focus also on growth factors. If a company is growing very, very fast, we want to know why, and we want to know whether that reason is sustainable. If there's a valid reason and it's sustainable, we really don't care that much about valuation. If you're growing at 30% and that looks like it's going to be sustainable, and you've got this, that, and the other thing, or a competitive advantage, you may have a very, very expensive stock, but if you're growing at 30% for 5 years, you're going to have a very, very solid business as well. So we do like growth rates, return on equity, balance sheets as sort of key things to look at. So if I can quickly summarize that up, if you've got a strong company and it's growing, and you're in an industry that's growing, I like to call that a double-double, where you have a company that's growing fast in an industry that's growing fast. You have a bit of an advantage there because, as we mentioned, if the sector's growing fast, then all companies can do well. And if you're doing better than others, then it's the old Tim Hortons double-double, where you're doing better while you're growing at the same time. If you've got a competitive edge, maybe you've got a patent, maybe you've got a new device, maybe you've got a new product, a new solution, that's great. If you can keep that advantage by spending money, making sure that your next version of your product is better than the last version, making sure that you add sectors, i.e. BlackBerry, which didn't even care about the consumer market, they only cared about the business market. Keep the advantage, keep spending money to maintain the advantage, perhaps buy out your competitor that's making inroads into your customers. You've got some money, you're well financed, maybe you've got a partner, but you've been through it all before, you've been through a recession, you're cash flow positive, and a recession/market correction is not going to destroy the company. So far so good. You can communicate to investors. You don't overpromise. You have good management. You've got a good board, and your management owns 30% of the company. So far so good. And then finally, attractive valuation makes it even better. So we put that last because if you have the other 6 points, really don't worry about the nickels and dimes. If you've got a great company that has all of those features to it, just buy it and hang on for the ride. I'm going to skip a bit to dividends because do-it-yourself investors really like dividends. My wife's a teacher, and I do some school presentations once in a while, and I really like to tell the students that being teenagers, they tend to be lazy. And I can say that because I've got 2 teenagers. If you're a lazy investor, why not get free money every 3 months? And oh yeah, by the way, every year you'll probably get a raise as well. And so you sit on the couch, you get money every 3 months, and then once a year you get more money every 3 months when a company increases its dividends. And so I use that to kind of wake up the class a little bit. Doesn't always work, but at least it gets them paying attention to see how they can get some of this free money. So dividends are great. We highly suggest looking for stocks with them. They don't have to be necessary for growth investors, but they do have some good advantages for investors as well. And let's look for what you need to look for in a dividend stock, assuming you want to have a dividend stock. So what we like to look at is we really are intrigued by first dividends. Board of directors does not make a dividend announcement lightly. They have to ensure that they have the ability to maintain that dividend for as long as possible. So the first dividend is a very good signal as far as we're concerned. But you want it to be sustainable. You don't want a company to come out with a 6 or 7% dividend. You'd rather have a 1% that grows to a 6% dividend over time and keeps growing year in, year in. Every year they give you a little bit of a bump up in the dividend, and the stock tends to do very, very well. So look for dividend growth. Consider the payout ratio. We tend to look at cash flow versus what's paid out as dividend. Debt to equity. Obviously, again, if you have a lot of debt and business goes south, you have two options you have more than two options, but for this example, you have two options for your money. You can pay your debt off, or you can pay your interest for your bank, or you can pay dividends. Well, guess what? If you don't pay your debt, the bank's going to seize your company. So guess what is going to win in that fight between interest payments and dividends? Yep, the interest payments are always going to win. So if you have a company with a good balance sheet, your dividend is far more likely to be sustained and or raised. Look at revenue growth. Look at sales growth, cash flow growth, and just be careful in terms of how a lot of people calculate dividend payout ratios differently. We like to use operating cash flow. Everything else is typically and usually discretionary. And so a lot of people may look at some acquisitions and things like that, but acquisitions are discretionary, and if you want to maintain your dividend, you don't have to make an acquisition. You could actually not do the acquisition and keep paying your dividend. This chart is a little bit old, but I wanted to include it because it includes the 08-09 financial crisis. And I'll sort of skip this because you can get the slides, and it's just a situation where it's just a graphical proof that dividend stocks tend to do better than non-dividend stocks. And there's plenty of reasons for that, which we'll touch on in a second or two. First dividends. The point is so important. We'll make it again. Just an example there. Martin Ray had their first dividend 5 years ago, and then this year they raised it by 50%. Fortis has paid dividends. I think it's actually 50, but I didn't have time to confirm that, so I put 40 because I know it's 40. 40 years of dividend increases. And take a look at the stock price, $5 to $42. Premium Brands, a bit of a smaller company. We do cover Premium Brands at 5i, but the dividend has done very, very well in 10 years, and the stock is up more than 13-fold in 10 years. And so that's a great example there on that price. Premium Brands has gone from $7 to $92. Say you bought it at $7, you had a triple. I don't know what year that would have been. Say there was a triple in 2012. If you had sold your triple, you missed another quadruple from 21 to 92. So when you have a good company, make sure you keep it. A company that goes up 5,000, 6,000% can offset a ton of loser companies, which can only go down 100%. I love how the math works. So you want to have consistency in your dividend increases. You want slow and steady. A couple of more examples there, Stantec and TELUS. You really would like to look for companies that can increase their dividends during a recession. And TELUS, the phone company, actually did that. The world was ending in 2008, 2009, and guess what? They raised their dividend twice during that period. So if there's a company that can raise their dividend in that period of time, obviously they're probably going to be okay in a normal scenario as well. So here are the reasons why dividends are so great. And just from an investor point of view, dividends prevent you from selling. If you have two companies, the market's going down and one's paying you every 3 months or every month and one's not, you almost always will sell the one that's not paying you any income, and you'll keep the dividend company. That makes them more stable than non-dividend companies. Dividends make sure management stays disciplined. We're talking about that acquisition that might not be made because they want to pay dividends. That cash going out every 3 months or every month is very, very good to keep a company management in check. They have to pay that dividend to ensure their share price, basically, and to keep their investors happy. So they tend not to go crazy with debt. They tend not to go crazy with acquisitions, and it's just a nice little gut check for management. Dividend stocks get better valuations, partly due to the above, but basically the stability is big for dividend companies, and if you have a more stable stock, you tend to get a much better valuation, and we've proven that with that chart, and that continues to be the case going forward as well. Good things to watch for when you're looking for a dividend stock. One of the best things is happening right now is when you have a situation where the whole market's going down, but companies are still increasing their dividends. And so if you look at Transforce, which is now called TFI, they raised their dividend 14% this week in the middle of a stock market correction, and that may get not noticed by investors. I think the stock barely budged when they moved their dividend up 14%. But that 14% basically tells you that the management's very confident that business is going to continue to be good in the next little while. So sometimes you'll get a very good scenario where you can get there's no free money in the stock market, but this is about as close as you get when the whole market goes down and a yield goes up because the whole market goes down even after an increase. What to watch out for? Watch for companies that increase their dividends even though their earnings and their sales and their fundamentals don't justify it. See this all the time where a company is worried about their stock prices. Perhaps they need to raise money down the road and they just do not want to disappoint investors, so they raise their dividend when perhaps they should not. And you have to be very careful. So basically every time you see a dividend increase, make sure that the company can justify that increase by what it's done for its investors and what its forecast is and what its earnings and cash flow are. What to watch out for? High yields, of course, are very telling. Who did we have this week or last week? Chorus had a 24% dividend yield, and then of course they cut the dividend, and the 24% basically told you that the dividend was going to be cut, and sure enough it was. Just be very, very careful. Do not reach for yield. There's lots of 10% yields out there right now in certain sectors, but when a dividend gets cut to zero, your 10% goes to zero. But of course, your $8 stock goes to $3, and it's a very, very big hit when a company cuts a dividend or eliminates the dividend. The first dividend cut, MCAN cut their dividend a little bit, I think a week or two ago. Just be very, very cautious. It's almost never the only cut. When a company cuts their dividend, business is bad, and business does not typically reverse itself overnight. It usually takes a long time to reverse a decline. I used to work at CI Mutual Fund, CI Financial, and they cut their dividend a couple of months ago, and they said they were going to buy back stock instead. I just couldn't agree with that particular scenario. It's a tough business. The last thing you want to do is cut your dividend when your stock's being supported by your yield. And I think the stock's gone down another $4 or so since they made that cut. I'm not sure how many stocks they've bought back, but I just think that was a big mistake for them. So skipping dividends and just some general advice here. So we like to look at big moves. We get a lot of questions at 5i. We've actually answered 87,000 questions in our existence. And a lot of them used to be, my stock is down 2%, what's going on? Not to be flippant, but we really don't care if your stock's down 2%. When your stock moves more significantly, then we need to find out what's going on. But smaller moves, daily moves, weekly moves, monthly moves, you really don't need to worry about things too much. Sometimes stocks go down, sometimes stocks go up, sometimes there is no reason for those moves. And you can get yourself all in a tizzy trying to figure out why a stock went down 2% when really what you should be doing is using that time to try and find something else to buy, or something, or perhaps buy more, or just to find out what's going on with one particular small movement. So save your time, wait for something to move before you really have to find out what's going on. And we like to use 20% as sort of a rule. Something's happening if a stock, commodity, or market changes by that much. Get rid of your losers is the new title of this slide. You're going to have losers, and you're going to have to sell them, and keep your losses to a minimum, and your gains will just take care of themselves. And so it's a situation where we get also some questions where they're phrased to the such that, should I hope for a recovery? And of course, hope is not an investment strategy, and getting your money back is not a good strategy either. So You're going to have some losing stocks. If you don't have losing stocks, you're not trying hard enough to make money. Just get rid of them, move on, reward the good companies, reward the companies that are doing well. And a company that's doing well tends to attract attention. If we go way back to my earlier slide with Diedrich Coffee, we'd never even heard of the company until it went from $1 to $2. It was doing very well, and guess what? We liked it, we started buying it. If a company's not doing well and the stock's gone from $4 to $2, we're likely just to ignore it. Look for blue sky. Analysts tend to be very conservative. Analysts have a great job. They get good hockey tickets. They get paid a lot of money. They don't want to lose their job. So they tend to follow the herd. They tend to be conservative. They may think a company is really, really great, but they'll just say it's pretty good, because if they're wrong, they're going to look bad if they pound the table on a stock. So we ignore target prices. We don't be a dreamer, but know what could happen if a company continues to do well. Say a company grows at 30%. Instead of saying, oh, that's too high, it's never sustainable, just ask yourself, what happens if that goes to 40%? And perhaps, why is it grown at 30, and what are the underlying factors for it to grow at 30? And how high could that stock go if it actually went 40% growth instead? All the analysts, of course, will change their target prices, and they'll be conservative. But just know what could happen if things go well. Again, don't put your rose-colored glasses on, but just don't be too conservative either. Not sure if this is a final tip here, but if you found a diamond in a garbage can, it would still be a diamond, and you'd probably take it out. Sometimes it takes patience with your stocks. Sometimes you'll question yourself, but again, that goes back to the fundamentals, and find out why you bought a company in the first place. If it's not performing well, just find out why. It may be a loser, or it may just need some time. And it's a little bit contradictory to sell your losers, because I would consider the fundamentals and not necessarily the stock price. Sometimes you will get a stock prices down where a stock, or where the company itself is doing quite well. So take a look at the fundamentals to decide whether you've got a losing investment or not. Don't really look at the stock price too closely. That will take care of itself based on the fundamentals. Some more final things. I used to charge 2.5% fee in my mutual fund, and it just kills me to actually say that, because it's just the most ridiculous thing I could ever possibly state, but that was the case. So keep your fees as low as possible. Keep it simple. If you've got a complex product, it usually means more fees, and it usually means not enough investment returns, because sometimes the complexities will cap your returns. Be aware of conflicts. If someone's telling you to buy something, ask yourself, what do they have to benefit from that? Because nearly everyone will have something to benefit from your money. And just remember that no one cares more about your money than you do. So just make sure that you know that when you're actually executing a trade or executing a decision. Make sure it's best for you and not best for your advisor, your broker, your trader, or whatever. And then sort of final point, in a market like this, doing nothing is often the best move. You do not have to react. There's nothing that says you need to sell your stocks because they're down 5%. The investment industry wants you to react. They want you to trade. They want you to be scared. They want you to give your money to an expert so they can charge a fee. But there really is no obligation for you to do anything. And sitting out a correction is often the best strategy. We will get over this, and the market will get back up one day. I can't tell you when, but I can give you 100 years of history that will back that up. Every single correction, every single crash, every single crisis has been recovered. Some take longer than others. Some take a very, very short time, but they've all been recovered. So every single correction in the history of the stock market has been a buying opportunity. So that's it. Hopefully that has helped. On 5i Research, we cover 70 Canadian companies. We only cover Canada. We don't manage money. We do not have any relationships with clients, with companies. We don't care if a company is offended by our research report if we say it's a lousy company. We have 3 model portfolios. Our balanced equity portfolio is up about 21% a year over the past 5 years. Doesn't include October, so take that down a half a point or whatever the math works out to be. And then we have a very popular question and answer service where As I mentioned, we're getting close to 100,000 questions answered. Most are available in our archives, so you can find out what we said 5 years ago on a company. You can ask a private question as well. It doesn't have to be public. And that's been really quite helpful. And just as an example, if we go back to Constellation Software, about a month or two ago, we had a client ask us a direct question on our question service. I think Constellation Software is too expensive at $850. I'm going to wait for a setback. I'm going to wait for it to go down to $750 or $700. And we just referred that client to a question we had in 2012, where we had another client give us almost the exact same question, but they were saying, I think Constellation is too expensive at $98. I'm going to wait for it to go to $80. And here we are 6 years later, and the stock was above $1,000 not that long ago. And so the archived questions can be very helpful when you're looking at a company and seeing how things have changed over the past 6 or 7 years. So it's a nice little database that we're building up there. We have a bonus for the webinar attendees. You can get 25% off your 5i subscription. And if you go to the webinar link there, that'll set you up for all those nice discounts. Thank you. We're going to go quickly to questions. And we're going to keep the questions for the webinar relatively short, but we will attempt to answer all your questions anyway. We want to get people back to work, and we don't want to keep them too long. So if you have a question that's not answered, we will attempt to answer it over the next day or two. Okay, so one question is just they want to know about a company we follow called Covalon. Covalon is a medical products company that has a nice little solution for things like dressing wounds and bandages and things like that. They won a $100 million contract, which was largely based in Saudi Arabia, so the stock is down a little bit because of the Saudi conflict with Canada and the U.S. But management has done it before. Management sold companies before. Insiders own 44% of the company. The company has no debt, and we kind of like its solution. Obviously, it'd be great to have some larger contracts elsewhere. They did a U.S. acquisition, which will help in that regard over the next couple of years. But management, it hits a lot of the buttons we look for. Balance sheet management, growth, competitive advantage. They won a $100 million contract against companies such as J&J and some very, very large worldwide healthcare companies. So, so far so good. The stock's gone from, I think it went from 1 to 9, and now it's back down in the 6 range, but we would view that as a sort of a 4 or 5 year term at least. Question on Chemtrade, is it still worth holding? Chemtrade is a tricky company. It's a chemical manufacturer, chemical producer. It's made lots of acquisitions, which were okay, but it has not raised its dividend since 2012. It's got a lot of debt through those acquisitions. The valuation's still not cheap, and the growth rate is still not very impressive. So we would kind of put it in the so-so, don't need to own category. They need to make some better growth rates there. They're in a competitive cyclical industry, and it's a situation where they're not always in control of their own destiny. If chemical prices fall, then they get hit. And so they really haven't proven themselves to us over the past 6 or 7 years, and it's just we don't need it. We don't see it as a need to own type of stock. Okay, some more questions. Question on oil. Unfortunately, the Canadian oil market is a bit trapped right now because of the pipeline capacity. We see oil as a sector to own, but only in a 5% type of range for a portfolio. There's really no need to go very big in the energy sector as far as we're concerned. And just we were talking about the TSX earlier. The TSX is still 19.5 or 20% oil, and we're suggesting 5% is about all that you need right now. So there's some companies out there. We like a couple of companies that they have outside Canada investments, such as Parex and Vermilion. And we think oil is okay, but the Canadian scenario would much rather have a U.S. or an international oil company right now. Some more question. One of the questions is very tricky to answer. It's who are the big sellers in this pullback? Institutions, hedge funds, or individuals? And is there a way to determine what's going on? We can look at individual trade sizes for each stock, and you can sort of see what trade sizes are. And obviously, if institutional investors are selling, keep in mind they're also buying. But if you look at trade size, and it's 100 shares or 200 shares of an $8 stock, it's probably individual. We use this off Bloomberg. most brokers will provide you with some indication of trade sizes. Right now, it looks kind of across the board. There's a lot of institutional sector rotation going on. They're selling tech, buying healthcare. They're selling other sectors to buy utilities on anticipation of interest rates peaking. Utilities will do pretty well, hopefully, when interest rates stop going up, and that's probably not that far away. So right now, it's more rotation. The end of the year will be quite telling to see what happens. So the markets in the U.S. are barely up on the year right now as we speak, and it'll be a situation where institutions will start to position themselves for next year. There is still money out there, and of course there's no net cash generated. When there's a sale, there's always a buyer. So to us it's just a normal correction right now, and of course we can't tell you when it's going to end, but it's nothing really unusual in terms of what's going on as far as we can see. Which company raised their dividend by 14%? That was TFI Group. The symbol is TFII. Is Shopify a buy at a current price? So we like Shopify. It's in one of our portfolios, and we do like the company, but it's a very, very expensive company, and it's just starting to make money. So while we really like the company, in a risk-off, nervous type of market, we would not expect the stock to do a whole lot and probably go down. It's just that type of a stock where if investors are worried, they tend to sell the expensive, riskier stocks first. But in terms of the actual management of the company, they have $1.5 billion in cash. They're growing at a remarkable rate. They do have a good solution. They've got a great competitive advantage. It's not one we worry about, and we're unlikely to take it out of our portfolio. And we do view it as a buy, but we would expect a lot of volatility until the market calms down a little bit on it. Let's see what else we got in terms of questions. We had so many questions. I'm trying to pick ones that are sort of that would be helpful to everybody as opposed to one person. How does an investor assess the quality of management? It is quite tricky, and this is where you just really have to follow a company for more than a short period of time. Most companies will outline their goals, and most companies at the end of a year will basically tell you whether they met their goals. You do have the earnings expectations and whether a company has missed or beaten earnings expectations, but you have to do a lot of reading here. You have to read between the lines and see what a company says about their scenario. And basically, it's without meeting them in person, where we as research people have an advantage, and you may not as an individual. You really have to read between the lines. You can go to annual meetings. They're kind of boring. But if you're going to invest in a company, we would go to at least one so you can meet the management team in the eye and listen to them explain themselves or outline their growth plans. And it's over a period of time. It's not something that you can do in a short period of time. You basically need to be able to have a belief that this company is run by competent people. And it is tricky. I'm not going to say it's an easy job. And especially even when you meet them in person, most management teams are very, very good salespeople, and they will tell you exactly what they think you want to hear. And so you have to be careful, and you have to take everything with a grain of salt as well. So over time, it gets easier. The more you read all their presentations, read all their excuses, read all their quarterly results, and listen to all their conference calls, and you get a much better sense of it. Another question. I know that Peter doesn't like to time the markets. Would I have stepped aside in these markets? So if I was running money right now, I probably would be doing nothing. I would just be sitting waiting for the correction to end. I don't know when it's going to end. I've got some good ideas of stocks to buy, but I don't know, if they're going to get cheaper tomorrow, next week, or next month. As a fund manager, sometimes it's beyond your control. You have either money coming in or money coming out. If I had money coming in, I certainly would be deploying it as a fund manager. And if I had money coming out, then you have no choice but to sell. And that's one reason why mutual funds actually have a hard time outperforming, is because some of that is completely beyond their control. 2008 was horrible for me because I had a lot of money leaving, and there was nobody buying any of my stocks. So it was a little bit worse than it would have been otherwise if money was coming in. So as an individual investor, you've got a huge advantage because you control your cash flows, and you can decide when you want to do something and when you want to pull money out and when you want to put money in. Most managers do not, especially if they don't like holding a lot of cash. I am going to do one more, and as I mentioned, we're going to try and answer all these questions offline, just so we can get people back to work. And okay, one question is, you mentioned the stock price prior, the old price or where the stock has been is irrelevant. Sort of, they just want me to expand on that. And basically, it is. The market is all about anticipation, what's going to happen in the future. You may have a stock that has done poorly, that's a great company, or you may have a stock that has done great, that is no longer a good company. So you have to look at earnings expectations, balance sheet, growth rate, cash flow, management, look at insider selling, everything you got to look at to decide what may or may not happen in the future. And I think the worst thing you can do is say, okay, this stock used to be $5, now it's 10. The stock does not know it was 5. It doesn't care it was 5. It doesn't care what you paid for it or what you sold it for. It's all about what it's going to do in the future and whether it's valued properly or improperly based on what's happening at that company at that time, compared to what's happening in the world and the market at that time. So really just look at where you think it will be and where analysts think it will be, and where earnings will be and where cash flow will be, and then decide based on the current price. And I really, really think that will be helpful. And again, don't ignore a company that's doubled, and don't get rid of a company that's gone in half without looking at the reason it's been cut in half. It may not be company related. It could be market related. And whatever you do, don't assume at $5 it's twice as good as it was at 10. That I think would be one of your worst mistakes. You have to find out, you have to do the digging and find out what's going on at that particular scenario. So.
All right, thanks so much, Peter. So what I'll do now is I'll stay on. Peter's going to leave, but I'm going to stay on to answer any questions that are non-investment related. So anything regarding the deal that we have for the webinar, anything regarding the presentation, that doesn't require Peter's brain. So I will do my best. I'm going to open up the questions here on my end, and I'm going to start answering the ones that I can answer. So give me one sec. Question of how many are on the webinar, close to 1,000. We had about around 1,500 that signed up. There's a question about the financial post offer. Yeah, so the financial post offer is independent of the 5i. So the financial post link that I showed you earlier, you can just sign up for that for the for the trial there. The 5i piece is completely separate. So you don't have to sign up to one and the other. Yeah, got another question. Does the 25% off include extending subscriptions? Yes, it does. Okay, I'm getting a question here. So one of the existing 5i members, they tried to renew with the offer, but were unable to see the discount. Yeah, this is, if you aren't able to see the discount, try selecting, there's a field where you select your province. Try selecting your province and see if that refreshes everything to show the discount. Usually that doesn't happen, but for some people we've noticed it does. So once again, if you are an existing member and you see the offer, but there's no, you basically scroll to the very, very bottom, and there you'll see the price with the discount subtracted. If you don't see that, make sure you have your province selected, and that should refresh everything. If it's still not working, or you're having issues, or you're getting frustrated, just send me an email here at the bottom, so cornell@5iresearch.ca, and I will, I'll still honor the bonus and all of that. If you're having technical issues, no problem. We'll get you sorted out. Can you go over what is included with the membership? Yeah, so with 5i Research, there's 3 main components. So the very first one is you get the company research report. So we have over 70 there right now. So we have new ones being issued. We have existing ones getting updated. So this is, when Peter and his research team look for the top companies to invest in within Canada, they do this in-depth analysis, and they publish these reports, and they give a grade rating. So, like a Constellation Software, for example, the last one was an A, right? So, and then you can read into all their details as to why they decided to give it that particular rating. So that's a big part. The second piece of 5i is the model portfolios, and so in there we basically, they do all their research on all the different companies, and then they constructed model portfolios for different types of investors. So we have a kind of an aggressive one, we have a balanced one, which is the one we were quoting recently, where it had something like 20% returns annualized over the past 5 years, and then we have an income one as well, where the returns So it's not as much focused on growth, but they're basically targeting 4 to 5% yield. So if you're a income investor, that's something that a lot of income investors find relevant or useful. And then it's up to you. Like Peter said, we don't manage your money. So these are model portfolios. We sometimes add companies to them. Sometimes we remove them. Sometimes we adjust our weightings in a company depending on what they're seeing. And then it's totally up to you what you do with that information. So we have the model portfolio. You see its performance. You see everything that's within it. And then you can pick and choose either which. We have some members that just follow that portfolio to the letter. We have others that pick and choose stocks within that portfolio. So it's totally up to you how you do it. But that's the second component. And then the third main component of 5i is the Q&A service. So you get 24 question credits per year that you can ask Peter and his research team. And like he said, we've already answered, I think he said over 80,000 actually now at this point. So you can actually go in the archives and see all past questions that have been asked as well, unless someone selected as private, because you have the option if it is a private one to say no, don't post this in the archives. But most people, they do public, and then it becomes a community basically, and you can see all the questions others are asking, and then then you can of course ask your own question as well. So it's a good kind of a research tool that you can use as well. And what you can do too is you can actually bookmark companies as well. So what you can do, if there's a company that you're following or that you want to receive updates on, you can actually flag it within the system, and you'll get an email anytime somebody asks a question about that company, or if we issue new reports about that company. And so it's a way, if let's say it's a company you have a relatively large position in your portfolio, maybe you want to track it. So that's an easy way to kind of stay up to date on what is happening. Is the slide deck available? Yes, I'll make it available as well. Okay, there's a question of where to find model portfolios. So once you log into the site as a member, on the left side, there's a navigation bar. You'll be able to see a section there for the Q&A, for the model portfolios, and for the reports. So you can take a look there, and each portfolio is in a different tab. So give that a shot. Like I said, if you can't find it still, if you're having any troubles with the navigation, you can email research@5iresearch.ca, and someone from the team will be able to help you pretty quickly, just because I'm going to be backlogged with all the emails everyone's been sending me today. Yeah, we have one question. Will our renewal date automatically be updated once we pay, or is it done afterwards? Yeah, so as soon as you pay, you should see, or you will see your renewal date increase. And so when you log in as a member, on the bottom left of the site, it shows you when your membership expires. That will be automatically updated to a later date. Okay, a good question. Are your company reports updated, or is it just a snapshot from that time and not necessarily looked at again? Yeah, so what happens is they do the company reports. It's all dated, so you know exactly when it was published and all of that. And then periodically they do update the different companies, especially if something material has happened at that company that would justify a re-examination of that company. So so we do have a fair bit of companies that do get updated, and you can actually see all past reports of a company. So you can actually search by company, either by name or by the stock ticker, and then you'll see all the reports you've ever published on that company, and you can pull up the most recent one at the same time. So that's kind of one way to research a company. The other one, of course, is you also go to the Q&A and you search for it there, and then you will see all the questions that have been asked about that company and all of Peter's and his team's answers. So he will do that for you. And then if let's say you see the report, but it's a bit older now, you're wondering if something fundamental has changed, or if you're getting concerned about that because maybe it is an older report, then definitely you can go to the Q&A and you can ask the question there, and they will let you know. So I think that's the best way, I would say, to get that taken care of. Oh, a question: does 5i Research cover ETFs or just stocks? So the company research, the research reports are about stocks specifically, but we do research on ETFs as well. And so for ETFs, really where you'll find it helpful is in the Q&A section. So in the Q&A section, you can go in there and you can look up whatever ETF is of interest, and just like with the stock, you'll see all the questions that everyone has asked about that ETF, and you can view our answers for that, and you can also submit your own. So if you're a purely 100% ETF investor, then you won't find the company research reports necessarily helpful because you're not an individual stock investor. The model portfolios consist of individual stocks, right? So you're not gonna use that if you're a 100% ETF investor, but you will find the Q&A section useful. We do have another service called ETF Fund Update that you can check out, which is also run by Peter and the team here, and that focuses specifically on ETFs. I'm not trying to sell this thing or anything. It's just you asked, so I just wanted to show you. So it's ETF fund update. So this is also run by Peter and the research team, and here they cover ETF specifically. It's like a monthly subscription, and this basically fully focuses on ETFs. So if you're 100% ETF investor, then this is probably a better fit for you. However, you can still use the. However, most people we find are a bit of both, right? Like they have their ETF, they might use ETFs, for example, for their international exposure, or at least, outside of Canada and US. And then in Canada and US, they pick individual stocks for their portfolio or a combination of the two, right? And so 5i is particularly useful for those types of subscribers. And of course, obviously for people that are 100% stock investors as well. Okay, great question. We have another question here. Once we subscribe to 5i, how do we receive the information? Is it in the form of a periodic newsletter, in an email, for example? That's right. So every 2 weeks, roughly every 2 weeks, we send out an email. And what that will have is it typically provides you with a bit of a market update. So something similar to what Peter talked about today in the beginning of the presentation. So we talk to you about what we're seeing, and we also let you know about any new reports that have been issued, any of the new company reports that we've issued, any updates that were done. So any older reports that have now been updated, like we talked about, any changes to the model portfolio. So you'll hear things like, okay, we increased our weight in company X, we decreased it in company Y, we've removed this company, we've added this company. We don't do, as you know, Peter doesn't like doing a lot of trading per se. Like we're not trying to time the markets. We're not day trading here, right? But because they're always doing this analysis, they do see certain kind of opportunities and things of that nature, and so they do modify those portfolios. And so every 2 weeks you will get an update, and sometimes the model portfolios might not get changed at all. Sometimes there might be a few changes, right? And so whether it's weight or adding a position in a company or removing a position in a company. So all of that is covered in the emails, just to give you a full update. So that's basically what you can expect with 5i, is an email every 2 weeks with kind of all the updates. But of course, at any time you can log into the site and see everything that we have there, ask your questions, all of that. Oh, question, can you subscribe to ETF update without joining 5i? Yes, you can. Yeah, they're both totally independent companies. I mean, they're both owned by Peter, and he's the owner of both of them, but you don't need to have one in order to have the other. Yeah, you can just sign up just for that one if ETFs is more your area of focus, for sure. You don't have to do both. Okay, great question. Does Peter hold any stocks he spoke of in his presentation? No. So what we at 5i, both myself, Peter, all the analysts, basically everyone here, we're not allowed to hold stocks basically in Canadian companies, because if we do, then that could create a bias, right? Where we could, let's say Peter held a really big position, and then he says, oh yes, we gave it an A+ rating, and it's the great, you know what I mean? Then theoretically, not that he would, but theoretically, right, he could then wait for the price to go up, and then sell, right? So that's a really, really big thing that I know Peter's very keen on, is to make sure that 5i is conflict free. And so this is the best way to secure that, is that he's not allowed to own any of the Canadian companies, any of the Canadian equities at all, and neither is anybody on the analysis team, right? So it's not, so you never have to, which is pretty unique in Canada, because a lot of places have these subscription type services where they recommend stocks, but other people are allowed to own it. And so then you start getting into these, you start wondering, okay, well, are they recommending the stock because they already hold a position in it, right? Or are they, when they say to sell it, are they just trying to, maybe if they have enough influence, maybe they're just trying to lower the price, and then so they can go in and buy it cheaply, right? So you can get into all these different conflicts of interest. And so we avoid that 100%. By basically not being able to hold Canadian stocks here at 5i. There you go. So I hope that answers it okay. Yeah, it looks like that's everything. So thank you very much for attending the presentation. I hope you got a lot out of it. We try to make it as contentful as possible, and give you a bit of a market update, because I know the markets have been pretty rocky the past little while, and so it's great to have someone like Peter on to kind of share his insights, and so I really hope you enjoy that. So thanks for coming aboard, and have a great one, and talk to you at the next webinar. Take care. Bye.